Gold in 2025. Is this the last time to buy cheap? Gold is flashing a major signal. Prices are holding near all-time highs, but something bigger may be coming. While headlines scream inflation, recession, and rate cuts, one question looms large for long-term investors. Is this your last chance to buy gold while it's still cheap? Today we're diving deep into gold's 2025 setup, the trends, the risks, and the real opportunity smart money sees right now. This content is for educational purposes only and is not financial advice. This video is not sponsored. Everstead is fully independent. No paid promotions, no outside influence. Just honest research to help you invest smarter. For thousands of years, gold has preserved value across wars, market crashes, and empires. But in 2025, it's more than just tradition. It's a strategic hedge against volatility, currency debasement, and geopolitical risk. Central banks are loading up. Retail investors are turning to gold amid fears of a slowing global economy, and yet prices may still be early in their move. One of the strongest indicators supporting gold right now? Central banks. In 2022 and 2023, we saw record central bank purchases the highest in over 50 years. 2024 continued that trend. Countries like China, Turkey, and India are leading the way, diversifying out of US dollars. That tells us something crucial. Smart institutions are preparing for something big. Several forces are converging this year. Potential Fed rate cuts, a weakening dollar, persistent inflation, growing global debt. All of these reduce confidence in fiat currencies and make hard assets like gold more attractive. But there's more. 2025 also brings political instability in major economies, which historically spikes demand for safe haven assets. Let's be clear, nobody can perfectly time the market. But long-term investors don't need to. The real edge is positioning during consolidation phases, not during euphoric spikes. Gold right now is holding strong but hasn't yet broken into its parabolic phase. That window? It may be closing soon. Yes, inflation has cooled slightly, but it's far from gone. Core inflation remains sticky, and services inflation, particularly in housing and energy, is persistent. Central banks may claim victory, but real-world costs tell a different story. Gold thrives in such environments. It doesn't yield interest, but it protects purchasing power when cash loses value. Let's talk about trust, because fiat currencies are built on it. With debt ceilings, budget deficits, and rising rates causing strain, trust in traditional currency systems is wearing thin. Gold doesn't rely on political promises. It exists outside the system. That's exactly why sovereigns and high-net-worth investors are increasing exposure. Technically, gold has built a strong base above $1,900 to $2,000. Every dip is being bought. That's bullish. If gold holds above these levels and breaks out past $2,300 in 2025, it could target $2,500 and beyond, especially if inflation reaccelerates or the dollar weakens further. Comment below, what percentage of your portfolio is currently in gold or silver? 0%? 5%? 20%? Let's see where our audience stands. While equities remain volatile, gold offers uncorrelated returns. It's not about choosing one or the other. It's about smart balance. When tech stocks waver or earnings compress, gold tends to shine. That's why some investors are now reallocating 5 to 10% of portfolios into precious metals as insurance. Gold ETFs like GLD, IAU, and PHYS are seeing inflows again. After years of stagnation, retail investors are quietly returning. And when the mainstream media starts screaming gold rush, that's when latecomers arrive. Right now, we're still early. It's not just paper gold. Physical bullion demand is rising fast. Mints are reporting increased sales, especially in Asia and Europe. In times of uncertainty, many want tangible assets, coins, bars, vaulted gold. And as premiums rise, that can signal tight supply and surging demand. Quick note on silver. It often lags behind gold until it doesn't. When gold rallies, silver can explode. It's more volatile, more industrial, and more reactive to monetary shocks. If you're already in gold, silver might be a leveraged play worth watching closely. Miners like Barrick, Newmont, and smaller juniors can offer explosive upside, but also greater risk. They benefit from rising gold prices, but also face operating costs, regulatory issues, and market volatility. If you go this route, position sizing is key. Some ETFs like GDX or GDXJ provide diversified exposure. Here's a broader view. Global debt is at record highs. Real yields remain negative. Currency wars are back. These aren't just headlines. They're conditions where gold has historically outperformed. What about Bitcoin? Isn't that gold's competitor? In many ways, yes, digital gold is rising. But it's not replacing gold yet. In fact, many institutions are now holding both, Bitcoin for growth, gold for stability. This dual hedge trend could push gold higher as digital assets grow more accepted. Let's not ignore the risks. A strong US dollar, rising real interest rates, a surprise economic boom. Any of these could suppress gold temporarily, but none change its long-term store of value role. On a relative basis, yes. Adjusted for inflation, gold's all-time high was in 1980, equivalent to over $3,000 today. We're nowhere near that. So despite strong performance, gold may still be undervalued, especially in a macro environment this uncertain. This is important. Most people wait for headlines before they buy. By the time gold is at $2,500, many will say, "I knew I should have bought at $2,000. That's how fear works. It delays decisions. But long-term investing requires anticipation, not reaction. You don't need to go all in. But even a 5 to 15% allocation to gold can reduce volatility and protect long-term wealth. And if you're risk-averse, physical gold or low-fee ETFs are the simplest starting points. At Everstead, we believe in enduring strategies, not hype. Gold isn't a trade, it's a timeless asset. Whether you hold it in bars, ETFs, or vaults, it's about long-term resilience. 2025 may be the final window before a major revaluation. So, is this the last time to buy gold cheap? We're not calling a bottom, but we are calling attention. Because those who wait for the perfect moment usually miss it. Now watch this. 5 ETF trends that could define 2025 wealth. Your future portfolio might depend on it. This content is for educational purposes only and does not constitute financial advice. Precious metals are high-risk investments and may not be suitable for all investors. Always do your own research and consult a qualified financial advisor before making any investment decisions.